All right, let's get right into it. Just a few days ago, India's market regulator, SEBI, dropped an absolute bombshell. They pointed the finger at one of the world's most powerful and, honestly, most secretive trading firms, Jane Street, for pulling off a massive market manipulation scheme right here in India. This whole thing is a wild story about super smart algorithms, a huge legal mistake, and a secret strategy that quietly made off with an unbelievable amount of cash. And when I say unbelievable, I mean it. We're talking about 5,000 crore rupees. Just so you can wrap your head around that, it's more than $500 million US. And this was all, allegedly, profit from rigging the market. So how in the world did they pull this off? Well, the core idea was actually pretty straightforward. It boils down to 3 simple steps: pump, dump, and profit. And the place they chose to do this? The Bank Nifty Index, one of the most chaotic and popular places for millions of small, everyday Indian traders to try and make some money. So the big questions are, right, how did this strategy actually work, step by step? And maybe even crazier, how did a simple, clumsy mistake in a high-stakes American lawsuit blow the lid off this entire secret operation? Well, that's exactly what we're going to break down. First things first, to really get what's going on here, you have to understand who the players are. And believe me, this isn't just about numbers on a screen. This is a classic, straight-up David versus Goliath story. On one side, you've got the little guy, the everyday trader. And on the other, a massive, global firm staffed with some of the smartest people on the planet. And when I say David versus Goliath, I am not kidding. Just look at this contrast. Let's take someone we'll call Rahul. He's an Uber driver, makes about 25,000 rupees a month. He got into options trading and lost 2.5 lakh rupees. That's 10 months of his salary. Gone. Now, who was on the other side of that trade? Jane Street, a $20 billion company that hands out 4.5 crore rupees starting packages to the top graduates from IITs. It's not just a mismatch, it's a completely different universe. So what even is a quant shop like Jane Street? Let's break it down. You or I, we might buy a stock for 300 rupees, hoping it goes to 400 next month. Jane Street doesn't do that. Their supercomputers spot someone selling that same stock for 300 rupees, and at the exact same millisecond, someone else willing to buy it for 301. Their algorithms execute that trade thousands of times a second, grabbing that 1 rupee profit over and over and over again. And who builds these crazy fast algorithms? Well, they don't just hire smart people. They hire the absolute pinnacle of brain power. We're not just talking about IIT grads. We're talking about the All India rank #1. The actual top student in the entire country, like Pranav Goyal. These are the math geniuses and statistics wizards you are unknowingly trading against when you open that app on your phone. And getting a job there? Ha, good luck. Their interview process is a legend in the industry. They couldn't care less about your resume. Instead, they hit you with incredibly complex puzzles, probability brain teasers, and high-pressure dice games, all designed to see how your brain works under fire. It's less of a job interview and more of a mental Olympics. Okay, so you've got this super secretive, super elite firm making an absolute fortune. How on earth does their golden goose, their secret strategy, get exposed to the world? You might think a brave whistleblower, right? Or maybe a sharp-eyed regulator. Nope, not even close. It all came out because of a totally unrelated lawsuit and one lawyer's catastrophic slip of the tongue. Let's just trace the breadcrumbs here. It all kicks off in 2018. 2 traders create this amazing secret sauce for Jane Street. Fast forward to late 2023, the firm makes them sign ironclad non-disclosure agreements to protect it. But then, in early 2024, they do the unthinkable. They jump ship to a huge rival. Jane Street is furious and immediately sues them for stealing their strategy. And it's right there, in the middle of that legal battle, that everything goes wrong. Picture the scene in the courtroom. Jane Street's own lawyer is practically pleading with the judge. They're saying, "Your Honor, you don't understand. This strategy is our crown jewel. It's so unique that if we even say the name of the country where we use it, the secret's out. It becomes worthless overnight." I mean, the tension in the room must have been incredible. And then it happened. In a moment of pure carelessness that probably still gives them nightmares, the other side's lawyer, the one defending the traders, just lets it slip. He names the country India. And boom, just like that, a private legal squabble between 2 US firms suddenly puts the entire Indian financial market under a global microscope. Well, once that cat was out of the bag, you can bet India's market regulator, SEBI, jumped right on it. And when they started digging, they found it. They found the entire playbook. But to really get how this ingenious strategy worked, we need a quick, simple refresher on the weapon of choice here: options. Okay, let's not get bogged down in finance jargon. Let's use our Lakshmi lipsticks example. Say the stock is trading at 100 rupees, and you have a feeling it's about to go through the roof. Instead of buying the stock itself, you buy a call option. You pay a small fee, maybe 20 rupees, that gives you the right to buy the stock for 120 rupees anytime in the next month. So if the stock rockets to 200, you use your option, buy it for 120, immediately sell it for 200, and you've made a huge profit on a tiny initial payment. That's the magic of options, and also what makes them so risky. And here's the thing. In India, people aren't just interested in options trading. They are completely obsessed. Look at this number. A mind-boggling 99.6% of all derivative trading in India is in options. It's a massive, churning ocean of bets, which, for a sophisticated player, makes it the perfect hunting ground. And if you thought that was wild, check this out. In most markets around the world, the value of bets on the market, derivatives, is about 5 to 15 times bigger than the value of actual stocks being traded, which is already a lot, right? But in India, it's not 15 times, it's 400 times bigger. All that enormous volume created the perfect camouflage for Jane Street to hide their moves. Okay, so the stage is set. Let's pull back the curtain on the strategy itself exactly as SEBI figured it out. It was a beautiful and terrifying four-step dance. Step 1, the pump. Jane Street's Indian office starts buying up Bank Nifty stocks like crazy, forcing the price up. Step 2, the bet. At the exact same time, their Hong Kong office places a gigantic bet that the index is about to fall. Step 3, the dump. The Indian office suddenly sells everything it just bought, which causes the index to crash. And finally, step 4, the profit. The Hong Kong office cashes in on the crash that they themselves just created. And this is where you see the diabolical brilliance of it all. They knew they would lose money on the stock trades, about 200 crores, in fact. But they didn't care. That was just the cost of doing business, the entry fee. Because that small controlled loss was the key that unlocked a mind-blowing 4,800 crore profit from their options bets. They weren't predicting the future. They were manufacturing it. So, SEBI has got them dead to rights. The playbook is exposed, the money is all counted up. The big question is, now what? What happens to a giant firm like this? And maybe more importantly, what does this all mean for the millions of small traders who are on the losing end of this rigged game? Well, what happened next was, honestly, surprisingly fast. In February, SEBI brought down the hammer and banned Jane Street from trading. By July 11th, Jane Street had wired the full 5,000 crore rupees, basically giving back all the profits. And then, just 10 days later, the ban was lifted. Just like that, case closed, business as usual. But that can't be the end of the story, can it? Because we have to come back to the Davids. We have to come back to Rahul. This number, and it comes directly from SEBI's own research, is just heartbreaking. 91%. 91% of individual traders, people like you and me, end up losing money in this market. They are playing a game against opponents they can't even see. And that leaves us with the one final really important question. The Goliath, Jane Street, paid its fine. They wrote the check and they're back at the table. But for the small player, for every David out there dreaming of making it big, is the game any safer today than it was yesterday? Or is this whole system just a playground that was built by giants, for giants, where the little guy is always the one who ends up paying the price? That's something to think about.